Chapter 12. Investor Behavior-Based Finance. Section 12.1. Behavior Finance. The final chapter of the book delves into the intricacies of investor behavior-based finance. The chapter underscores the importance of emotional discipline in investment decisions, highlighting that many losses incurred by investors result from emotional indiscipline and the inability to delay gratification. It emphasizes the potential for long-term benefits for investors who choose companies wisely, based on sound business models. The chapter explores the extensive efforts and resources invested in studying listed companies, with a focus on technology breakthroughs, business models, market innovations, and management quality. Despite this, the inefficiencies of stock markets, especially in the short run, are attributed to fluctuations influenced more by investor emotions than fundamental company realities. The chapter talks about behavioral finance, challenging the traditional economic theory that assumes markets are efficient and decisions are always rational. It suggests that, in the short run, markets are not efficient, and decisions are often emotional. Investors' behavior, guided by greed and fear, leads to irrational decision-making, impacting stock prices. Mr. Parikh presents a nuanced view, encapsulating the flaws in thinking and introducing the idea that decisions are not solely rational but also emotional. Section 12.2. Stock Price. Moving on to stock price, Mr. Parikh unveils the goal of corporations is to maximize shareholder value, represented by the stock price. It acknowledges the stock price's importance in reflecting a company's status but questions its accuracy as a true reflection of a corporation's worth. The volatility of stock prices is attributed to unpredictable investor behavior driven by sentiments, causing disparities between perceived and actual company value. The chapter details how stock prices influence corporate decisions, affecting expansion plans, mergers, acquisitions, talent attraction, and credit ratings. It distinguishes the implications of a good versus a depressed stock price, elucidating the organizational consequences and long-term repercussions for a company. A company with a rising stock price represents a bright future. Its ability to attract best talent as employee stock options become very valuable for employees. The company with a healthy stock price is also able to negotiate favorable credit terms with banks and financial institutions, further helping fuel faster growth. Mr. Parikh further delves into the challenges of managing stock prices, considering the whimsical nature of transient investors and their emotional decision-making. It stresses the difficulty for companies to control their stock prices, given the unpredictable behavior of investors. Mr. Parikh emphasizing the transient and conscience-lacking nature of investors in the listed stock markets. They become shareholders to benefit from the movements in the stock price. It is their profits and losses that are important, and these are again the outcome of their emotional outbursts of greed and fear. Section 12.3. Role of the owners, investors. In this section, Mr. Parikh explores the intriguing dynamics of investor ownership in the stock markets. He questions the conventional wisdom of unwavering loyalty from investors, highlighting the rapid ownership changes facilitated by stock market dynamics. The paradox emerges as investors, despite having authority over a company, may lack responsibility. The multifaceted roles of investors, from capital providers to stock values, are unveiled. Mr. Parikh delves into the destabilizing changes in equity ownership, driven by the rise of institutional ownership and the emergence of professional money managers, leading to a paradigm shift in ownership dynamics. Section 12.4. Corporate Behavior. Mr. Parikh shifts focus to corporate behavior and the prevailing efficient market theory. He says that corporate managers, assuming rational investor decisions, concentrate on creating shareholder value without considering external factors. He says that the traditional emphasis of company managers to only focus on employees, customers, and suppliers but not worry about shareholder behavior can be highly detrimental for the corporation. He criticizes the one-size-fits-all communication approach followed by companies, urging companies to understand the complex behavior of investors and tailor their communication strategies accordingly. Section 12.5. Investor Behavior-Based Finance. Mr. Parikh further encourages corporations to follow investor behavior-based finance, emphasizing the need for corporations to comprehend and navigate the profile of their investors. The author suggests outlining a framework for profiling investors, identifying key players and big investors like mutual funds and foreign institutional investors which can play havoc with share price, and understanding their investment horizons and analytical processes. By studying investor finances and trading patterns, corporations can predict the potential impact of investor decisions on stock prices. Mr. Parikh highlights that stock volatility is influenced by the entire investor community, advocating for tailored communication to build a network of loyal investors based on shared perceptions. Section 12.6. Paradigm Shift. Research on investor behavior. In this section, the author emphasizes a paradigm shift in how companies perceive their investors. To comprehend investor behavior, the first step is profiling and mapping them. Identifying key investors is not solely about size. Medium to small traders, who are active, significantly influence stock prices. Understanding organizational safeguards imposed on active investors is crucial for companies. Mr. Parikh further advises companies to analyze the investor's time horizon and the content they focus on for investment decisions. Long-term investors, like Warren Buffett, base decisions on growth projections, employing a fundamental approach. Medium-term investors, labeled as news forecasters, look at events impacting a company in the medium term. Short-term investors, known as event bettors, focus on unfolding events, buying on rumors and selling on news. Further, the organization watchers prioritize organizational changes, reacting to restructuring, downsizing, or mergers. Strategy followers assess business strategies, scrutinizing changes in the business model, marketing strategies, or product innovations. Financial adepts focus on financial figures, reacting to quarterly results and creating market volatility. Management watchers emphasize the quality of management, considering factors like performance, integrity, and stake in the company. For organization watchers, changes like restructuring trigger trading activity. Strategy followers react to shifts in business models, marketing strategies, and acquisitions. Financial adepts respond to exceeding or failing to meet investors' expectations, as well as management warnings. Management watchers become active traders in the face of management scandals, regulatory proceedings, and internal control problems. Further, the author says that high-velocity day traders have minimal impact on stock prices, while low-velocity investors, like inheritors and retirees, hold stocks for sentimental reasons. Medium-velocity investors, specifically retail event bettors, contribute significantly to stock price impact, holding stocks for a few months to a year. Understanding investor behavior involves profiling key investors based on their time horizon, dominant content analysis, and triggers for activity. Companies can hugely benefit from such analysis to effectively communicate with investors, and the distinctions between high, medium, and low-velocity retail investors are also crucial to consider. Conclusion. To conclude, Mr. Parikh highlights the significance of investor behavior-based finance in the ever-growing global financial markets. As countries aim to attract capital for growth, stock markets emerge as a crucial route, facilitated by technology and information accessibility. However, this ease of transactions has led to a chaotic market filled with short-sighted and unpredictable investors influenced by emotions of greed and fear. Understanding these behaviors becomes imperative to manage perceptions and control stock price volatility, as investors are vital stakeholders in a corporation. The benefits of investor behavior-based finance include ability to understand the investor base better by identifying and mapping investor behavior. A proactive management based on this understanding allows for informed decision-making, instilling faith and trust with investors. Transparency in communication fosters investor-friendly strategies, ultimately reducing stock price volatility. The approach helps manage investor perceptions, promotes a better understanding of the company, and tackles irrational investor behavior. Additionally, it forms a crucial link with employees, customers, and suppliers, completing a holistic and strategic perspective for corporations. In essence, adopting investor behavior-based finance empowers companies to navigate the unpredictable nature of financial markets and build stronger, more transparent relationships with their stakeholders. We hope you liked the summary of the book, Value Investing and Behavioral Finance, by Parag Parikh. Stay tuned for upcoming book summaries. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interest ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in and one of our team members will get in touch with you.